What is a bridging loan? That is a very good question. And in this video, we will look at what bridging loans are and when are they going to be useful for you. Have you ever found yourself in a financial pinch, needing funds urgently? This is where bridging loans can be a lifeline for those moments when timing is crucial. Imagine spotting your dream home, but your current property hasn't sold yet. What do you do? That's where a bridging loan steps in, seamlessly bridging the financial gap. A bridging loan is a short-term secured loan designed to help individuals and businesses manage the interval between a payable expense and the availability of funds. Think of it as a bridge that gets you from point A to point B without a hitch, but it's a financial one. How do bridging loans work? Well, these loans are typically secured against property assets, but they can also be arranged against other things such as jets, yachts, jewelry, art, cars and wine. But in this video, we're going to focus on real estate, and here's a simple breakdown. You apply for a bridging loan offering collateral, usually real estate. The approval process will be an application where lenders will assess the property's real value to them and your exit strategy, which is how do you plan to repay the loan. Once the funding is approved, funds are dispersed swiftly, often within days. Repayment is normally at the end of the term, typically through the sale of the property or securing longer term financing. Many clients need to act quickly, sometimes either at an auction or if there's a property that's come up unexpectedly that has always been your dream home. So you go out, arrange the bridging finance, buy the asset, and then you look to possibly refinance this opportunity on a longer term mortgage. But the key thing here is acting quickly. There are a few different types of bridging loans. Sometimes the terminology is called a closed bridging loan. These are loans that have a set repayment date, and it's ideal when you've already agreed on the sale of your property. Open bridging loans, this is where there's no fixed repayment date, and it's suitable if you're confident about securing funds soon but lack a definitive timeline. What I have found during the last 20 years is that common uses of bridging loans are mostly used for property purchase. This is where you need to secure a new home before selling the current one. Auction purchases is also popular. This is where you need quick funds to acquire property at auction. Another developing factor we've seen in the market is property development finance. This is where you're renovating or developing and you don't have all the relevant approvals or the longer term funding in place. When you're in business, sometimes you need short-term cash. This will cover capital needs or unexpected expenses. The advantage of bridging loans is their speed, rapid approval and funding. Flexibility with the various types tailored to the different needs are also a key benefit. There is so much available capital to individuals and businesses with diverse financial backgrounds that benefit from bridging finance. The drawbacks with this type of money, or otherwise known as hard money in America, is that the interest rates are higher. This is due to their short-term nature and quick availability. You will have arrangement fees, valuation and legal as well. In terms of margins, bridging finance can start as low as 0.65% per month with fees of 2% and could be as high as between 12 and 20% depending on first legal charge, second legal charge, the loan to value, the location of the property. The risk to you as the borrower is that this type of funding is secured against your assets, so failure to repay will result in loss of your property or assets. There will be eligibility criteria depending on the lender. Collateral will always be property in the majority of cases, but you can use other assets if needed. The exit strategy is always vitally important for the lender. What is your clear plan for repayment? When underwriting from a lender's perspective, what is your creditworthiness? While more lenient than traditional loans, a decent credit history helps. As I've mentioned, interest rates and fees vary. When looking at valuations, lenders will assess what is the value of that property if they had to sell it at a 90-day time frame, 180-day and open market valuations. What this means is that how quickly can they get their money back? So a property will have different valuations, so i.e. a 90-day valuation, 180-day valuation and an open market valuation. They are all different depending on how quickly a lender will want to be repaid. This allows lenders to assess liquidity of your asset if things were to go wrong. You will need a lawyer and legal fees will be applicable. This will cover all the legal aspects of the loan agreement and the security that's being provided. With the repayment options, there are either monthly interest payments where you pay interest at that time with the capital, i.e. the amount that you've borrowed at the end of the term. Interest roll-up is another option, and what this means is that there are no monthly payments. The interest will accumulate over the term of the loan and is paid with the capital that you've borrowed at the end of the term upon repayment. The other opportunity, which is equally interesting, is retained interest. This is where the borrower borrows the interest up front to cover the interest interest payments for the term of the loan. This can be really interesting because it could achieve the lowest interest rate for your opportunity. And what I mean by this is if you're borrowing, say, £500,000, and then the interest rate from a specialist building society is 7, they will calculate either 12 months, 24 months, 3 years worth of interest and add that to the loan day one. So when the monthly mortgage payment is due, every single month they will deduct the interest from the amount that you've already borrowed. This is often the cheapest way to borrow with bridging finance, and it can give you longer term solutions, in some cases up to 5 years, but normally bridging finance is on average 12 to 18 months. With this type of borrowing, there are many risk considerations that need to be considered. The market will fluctuate, unexpected events, property values can change, and this will affect your exit strategy. And the most important thing is, are you being realistic with your sales price? Often when buying and selling property, there are delays and complications do come up. If your property doesn't sell as quickly as expected, you might face challenges when repaying. I've always found in life that normally the first offer is your best offer with a little bit of negotiation. Don't be too greedy. Additional costs. Unplanned fees can increase the overall cost of this type of borrowing. There are alternatives to bridging loans. These can be either secured loans, margin loans, Lombard loans, depending on what assets you own and what those assets are. Secured loans like second charges can be for longer term solutions, anywhere between 1 to 5 years. Personal loans, but these are for largely unsecured loans, normally below £30,000. If you have more time, you could look at a remortgage. This will release equity from your property and will often be the most cheapest or one of the most cheapest ways to borrow. How do I apply for a bridging loan? It's vitally important to work with a specialist and research the lenders that are available. There are so many. Look for reputable lenders with experience in bridging finance. Some will be regulated and some won't. What this means is that if you live in your main home and require bridging finance, because it's your main home, that will be a regulated transaction and you'll have to work with a regulated lender. During the process, it's vitally important, as always, when borrowing money, to get prepared. You'll need the property details, the proof of income, and a solid exit strategy. Always speak to a professional advisor. As I've stated in many of my videos, always seek expert advice. There are so many types of bridging loan lenders. From banks, one of these as an example is United Trust Bank. They can offer loans from $125,000 up to $15 million with terms up to 36 months. When working with a specialist, it's vitally important to compare all of the options available. Some will be great for smaller amounts, with amounts starting as low as $50,000, and others maybe up to $50 million. It all depends on what the asset is and what you're looking to achieve. One of our clients, Steve Davies, was looking for a bridging loan where he had found a dream home that was on the market for around £1 million, but he hadn't sold his existing property, which was valued at $700,000. Steve reached out to us and took a bridging loan to make up the difference to make the purchase happen. He borrowed the full amount with the bank that was lending the money, taking security of both the property he was buying and selling to give it additional comfort, so that there was a 100% loan on the $1 million purchase. Once the original property was sold, the existing debt was reduced from $1 million down to $300,000. In conclusion, bridging loans can be a powerful tool for those needing swift financial solutions. However, they come with risks and costs that require careful consideration. Always assess your financial situation and have a very clear exit strategy, and consult professionals before proceeding. Some of the questions that I get asked is, can I get a bridging loan with bad credit? Yes, as always, there are specialist lenders that offer bridging loans for these sorts of situations where people don't have perfect credit. This will be more of an asset lend, where the lender will assess the application more on the property's value rather than your personal circumstances. What are the negatives when arranging a bridging loan? They're not cheap and they can be very expensive depending on your requirements and circumstances. There is risk if you don't sell the asset that you're borrowing against, so always think very carefully before proceeding. What is the typical interest rate on a bridging loan? Depending on the overall individual circumstances, it will vary from rates as low as 0.45% and even as high as probably 1.5%. This will depend upon the loan to value, the location of the property, and the underlying circumstances of your credit worthiness and your balance sheet, i.e. what other assets do you have and how high a risk is the transaction from a lender's perspective. What can I use a bridging loan for? Bridging loans can be used for any legal purpose. How long does it take to get a bridging loan? Normally you can get approval within 48 hours, and if the lawyers are already engaged, you can draw funds normally in 10 working days, but it's always better to allow 15 for any delays. Normally delays come from valuers and valuations, as this is quite a lengthy process. What type of property can a bridging loan be secured against? A bridging loan can be secured against residential, commercial, and even land or agricultural buildings. Anything is possible with bridging loans depending on, as I've said earlier, the location of the property and your overall circumstances. Hopefully you found this video useful. Thank you so much for watching. Please remember to like and subscribe. It means so much to both me personally and the channel. Thank you.